What is going on, everybody? Welcome back to yet another video. In today's video, I'm going to be showing you guys how to properly draw supply and demand, and I'm also going to be showing you what to look for in the price action in order to confirm your trade. But real quick, before hopping into the video, make sure you guys are subscribed to this channel. I have over 600 educational videos teaching you guys on how to trade, and I can almost guarantee you that you are going to learn something new if you go through those videos. So yeah, make sure you guys are subscribed, make sure you guys like the video, and let's hop into it. All right, so before I show you guys how to actually draw your supply and demand levels, first you guys need to understand the difference between supply and demand. Supply is an area where there is a lot of sell orders in the market waiting to be filled, so supply is acting as resistance, and demand is where a lot of buy orders are sitting in the market waiting to be filled, so demand will act as support. So again, supply is resistance, demand is support. Now, the difference between regular support and resistance and supply and demand is basic support and resistance is more so telling you an exact area to watch, while supply and demand are actually letting you know a wider area to keep on watch for a possible bounce or for a possible reject. So let's start off by finding some demand zones. So in order to actually find a proper demand zone, what you need to find first is a basing candle. Now, what a basing candle is it's more so a small bodied candle before a nice aggressive move to the upside. Now, this isn't a demand example, but I'm showing this to you guys because this is an example of a basing candle. Notice how right here we had that small bodied candle before the strong aggressive move to the upside. Now, the thing is, when you're drawing your demand zones, the candle before the strong aggressive move up needs to be a red candle. So if we head on over to the 45-minute time frame, there's a very good example on there. So looking at the 45-minute time frame, notice how right here we had this small bodied red candle before a strong aggressive move to the upside. We had another one right here, small bodied red candle, very strong aggressive move to the upside. We had another one right here, small bodied red candle, strong aggressive move to the upside. So in order to identify your demand point, you need to identify that small bodied candle, again, basing candle, and then the aggressive move up. Now, the reason why this becomes demand is because you got to think that there are orders waiting here that were not filled on this aggressive moves up. Big funds aren't going to be chasing the market up. They're going to be waiting for the market to return back to where they were trying to purchase, and then they're going to get their orders filled. So taking this basing candle right here before the strong aggressive move up, let's just imagine that there was 100,000 ES contracts that were not filled right here. That fund is going to be sitting here waiting for ES to come back to that price to then get filled. Now, when it comes to drawing your demand point, what you want to do is you want to mark the bottom wick of the candle. In this scenario, the red candle, again, remember, it has to be a red candle. If this is green, it is not demand. You're going to have to change time frames, and we're going to come back to that here in a little bit. So what you're going to do is you're going to mark the low of that red candle, and then you're going to mark the open of that red candle. So the demand point for ES would be in between 40.76 and 40.68.75. So once you have those 2 points marked, what you're going to do is take the rectangle tool and you're going to measure from the bottom to the top, and you're simply going to project it going into the future. So then from here, I personally make mine this little cyan green color. And what you can do so it doesn't look like this, like literally you would not be able to see price action in this. What you can do, go to edit properties, click color, go to more, and then go to HSL, and you can actually change the transparency. So let's just put it on 70. And now from there, you can see that you're able to actually see the price action through this area. So a nice little tip for you guys. So since the orders were not filled at this point, as price comes down to this level the next time, we would want to be looking for a bounce. Now, for demand, I've noticed that the higher probability bounces happen at the very top of the range. So in this scenario, because 40.76 is the top of the range, that is where the higher probability bounce will be. Sure, it can trade down into this 40.68. When it starts trading down into the demand area, you really need to be focusing on the price action. If we start getting bullish hammers or very long lower wicks, that is letting you know that those buy orders are being filled. And if you use Bookmap, I made a Bookmap video on this channel yesterday. Make sure you guys check that out. It also helps you identify where those buy orders are sitting. But like I said, the higher probability bounce areas are going to happen right at the very top of that demand zone. So as we see, what ended up happening in the overnight session is we ended up gapping down right into the demand before we ended up rallying to the upside. So what we're going to do is we're going to break it down to a 5-minute time frame. You can see that price came right down to the very top of that demand zone at 40.76, and then it rallied all the way up into a high of, I think, around like 41.18 before it started to pull back today. So let's zoom out to, let's try a 1 hour time frame, see if we can find some demand zones. So I would also consider this a demand zone right here. Again, we have that small body candle before the strong aggressive move up. Now in this scenario, the demand did not end up working out. We ended up breaking below it. We also have another one right here, a little 1 hour demand. But in this scenario, what I want to show you guys is notice how this green lower wick broke below the red lower wick. This is a different way that you would draw your demand zone. So what you would do, because this green candle wick broke below the previous, you would actually just go ahead and mark the low of that green candle and then the open of that red candle. And then this is going to be your demand zone right here. But as you can see, once price traded down into the very top of that zone at 41.23, had a nice little rally up into like 41.30, so like a 70-cent move on SPY. But ultimately, it was not able to hold the demand, and it ended up falling lower than that. So here is another example of demand right there. And then we have another example on the 1 hour right here. So with this demand zone, little different. We have a nice rally in the market. We have that smaller bodied red candle before a very strong aggressive move up. Again, more than likely, there is buy orders that were not filled in the market right here. So what we can do is we can watch this area for potential demand as well. It's going to be a little larger of a zone, but what you're going to do is the same exact thing. Mark the low, mark the open of that red candle, and you can see as we came down to test the high of that demand zone the very first time, price rallied from 41.33.5 all the way up into a high of 41.64.25, came back down again, tested the demand, pushed back up, and then that's when we finally fell below. So again, all you would do is take the 41.24 area all the way up to 41.33.5, and this would be your demand zone right there. And then real quick, in case you guys did not know, I do have a 450-page book on Amazon titled The New Age of Technical Analysis. So if you guys are looking to learn more about my day trading, swing trading strategy, how to find bounces, rejects, support and resistance, Fibonacci, the indicators I use, and so much more, make sure to check out my book, The New Age of Technical Analysis, 450 pages. The link will be down in the description. Now, when it comes to demand or supply, I do not use it in a way that if we were to break below demand, that it would then become supply. I know some people like to use that. Personally, for me, when I'm using supply and demand, if it breaks the demand zone or breaks the supply zone, I'm no longer interested in it. All I'm going to do is just simply delete it from my chart. Now, again, we have another demand zone right here. As you see in this scenario, the green candle breaks below the body of the red candle. All we're going to do is take the green wick up to the open of the red candle right there. And this is going to be the demand zone. As you see, once we started pulling back, we were able to find support a little deeper into the demand zone before it ended up rallying to the upside right there. So when it comes to trading based off of these supply and demand zones, typically I like to trade the first touch of the zone or the second touch of the zone. Typically after that, it tends to get a little more weaker each time as those orders are being filled. So the first time it comes down into that demand zone, it makes it a little higher probability because those orders have not been filled yet. But say it comes down, test it, rallies, some of the orders have been filled, comes back down, test it again, orders have been filled, say it rallies after that, and then it comes down a third time. Well, we already tested the area 2 times and most of the orders have been filled. So again, in my experience, the first touch of that new demand or supply zone has been a lot higher probability. Now, before we hop into supply, when it comes to identifying where these zones are, you do have to go around and look at different time frames. Personally, when I'm using supply and demand, I'll start on the daily. So as we see right now on ES on the daily time frame, this is daily demand right here. This was daily demand right here. We ended up dropping into it this day, so a nice little rally to the upside, but ultimately we ended up breaking below it today, so therefore it is no longer valid. This is another example of a daily demand zone, but after I'm done looking on the daily, I'll then go to the 4 hour. Same thing on the 4 hour. I'm looking for those small bodied red candles before a nice rally to the upside. So here's an example of demand right here. Another trick, typically, if you start looking at the bottoms of price action, that's where you're going to be able to find your demand. So here would be a demand zone. Here would be a demand zone. Here would be a demand zone. So after I'm done on the 4 hour, I'll then go look at the 2 hour. Once I'm done looking on the 2 hour, again, here's another demand zone right here, demand zone right here. You're going to start identifying many different demand zones. Once I'm done on the 2 hour, I'll break it down to a 1 hour. Now, the reason you're breaking it down to different time frames is because on one time frame, it might be a green basing candle, or it might just be a completely different candlestick formation. But when you drop at a time frame, that's when you see that red basing candle before the large aggressive move up. That's why we start using different time frames. So then after the 1 hour, I'll start breaking it down to maybe a 30-minute. If I start seeing something that looks like a basing candle before a strong aggressive move, then I'll start playing around with like weird time frames. Like earlier, you guys saw me on the 45-minute time frame. That's because right here, it looks like there's a demand zone and you can't see it on the 1 hour. Can't really see it on the 30 minutes. So you got to get creative and then break it down to a 45-minute time frame. And then that's when you would be able to identify where that demand zone would be, as you see right here. So the lowest I will go is a 30-minute time frame, nothing under that. So that is how I draw my demand zones. Now, when it comes to supply zones, it's pretty much the same thing, but flipped upside down. So what we need to identify is a green basing candle before a strong aggressive move down. So in this scenario, we have a small green candle before a strong aggressive move down. So because of this, what you would do is you would mark the high, the upper wick of that green candle, and then the open of that green candle, and then that would be your supply zone. So all you would do at this point, you would take your rectangle and you would measure it right through here, and I just make mine this reddish color right here. Again, go to edit properties, click more, go to HSL, and you can change the transparency from there. So that's a supply zone. This would also be a supply zone right here. It's just a little larger of a zone that I typically like to trade. So typically what you can do is in the larger zones, like this is a daily zone right here, you can typically break it down and find a smaller zone in that area. That way it allows you to find a more precise area that you can watch for a potential reject. So as we see with ES, it came right up into daily supply right here, and it ended up rejecting to the downside. So again, we had that small bodied green candle before the large aggressive move down. Now we also have another example of demand right here. So I'll take the high of this red candle because it broke above the high of the green candle to the open of the green candle, and then I would project it to the right. This would let me know that this is potential supply. So therefore I would want to look for rejects. Same thing right here. This is demand right here. You can see we had this basing candle, very large aggressive move down. When we came back up into it, we rejected it pretty hard and ended up pulling to the downside. Just like demand, what I would do with supply is start breaking it down daily, 4 hour, 2 hour, 1 hour. Start playing around with custom time frames. If I start seeing potential areas of supply, but it's not clear on one time frame. But again, the lowest I will go is a 30-minute time frame for supply. With supply zones, just like demand, the higher probability rejects are going to come at the very beginning of that zone. So here's a really good example of a 2 hour supply zone right here. Again, as you can see, we have a small bodied green candle. This is why it's important to play around with different time frames, because you can identify it on the 2 hour, but not so much on different time frames. We have this small bodied green candle, very aggressive move down right here, leaving sell orders pending. As we see, once price came up, tested the area, saw a nice little flush to the downside. So as price starts coming up, you want to watch the very beginning of the zone, which in this scenario would be right at 41.95. And as you can see, price pushed up to 41.96 before it rejected and came all the way down into 41.81. Again, remember the higher probability reject zones are going to be at the very top of demand and at the very bottom of supply. Use smaller time frames, 5 minute, 10 minute, 1 minute to confirm your entries. Look for volume, look for aggressive orders coming through on the market. If you like to use Bookmap, Bookmap is fantastic when identifying your supply and demand levels to see if there's truly orders sitting in that area. So again, make sure you guys check out that Bookmap video that I uploaded last night. That link will be down in the description. That is going to wrap up this video on supply and demand. If you guys did find value in this video and you do want to see more supply and demand videos, make sure to like the video, comment down below letting me know that you want them. Everybody have an amazing rest of your day, and I'll see you guys in the next video.